my first watershed event in investing was the Asian crisis. That's when I started investing, was in 96. The last quarter of 96 was the first quarter. Then in 97 we went headlong into the Asian crisis. The operating principles have always been the same. The whole focus on survivability. I mean, safe and cheap has taken you through the Asian crisis. So, I mean, the learning that happened then, even before the Asian crisis, because I'd spent a number of years working with Marty by that point in time. So the focus on survivability has always been a very big part. Because when I started here, we went headlong into what we had in 1990. There was a big financial crisis, which was when Drexel Burnham blew up, the high-yield debt market blew up. A number of life insurance companies were going to blow. In fact, the entire life insurance sector was going to go. In fact, property casualty companies got in trouble because this precipitated commercial real estate crisis, which also insurance companies had. So there were multiples of interlocking financial things. That was the beginning of my investment education was here. So going off on my own in the way of investing, I go headlong to the Asian crisis. So, okay, we have our own crisis to deal with now. So it was actually very simple. You just avoid companies which have, and the valuations you'll be presented with in those sort of periods is so ridiculously stupid. You know, companies are just swimming in cash, no reason to borrow, and you get an operating business for free. Now that sounds good. You could do that. I could live with that. And of course, those companies were multi-bankers after that. But importantly, though, you know, what particularly colored me was how capital markets can close down. It didn't really happen in 1990. The high-yield debt market sort of imploded and closed down. But here, the visual experience of watching people line up to pull their money out of Thai finance companies in 1998 July is a rich experience. It's one that sort of continues. So if you're a company looking to run your business, and arguably in those days, you know, nobody really thought that would ever happen there. And of course, a lot of people got flat-footed. So that tells you what you have to do and what you don't have to do. You don't want to be in companies that need to borrow to keep their business going forward or access capital markets. So that's always been a cornerstone. Second, the other thing about that financial crisis, the other learning aspect, which is also true for subsequent such events, is you can buy stuff very cheap and gets cheaper. So you buy things slowly. You value very conservative, value for worst case scenarios, and then start your buying. And assume that it's going to get cheaper. When people are in the middle of this mad panic, value has nothing to do with them. They just want to extract the cash and separate themselves from that piece of paper that keeps going down the next tick. And so, of course, I'm there buying it, and it goes down the next tick anyway. So I keep buying some more. I mean, look, a favorite example of mine was a Japanese securities brokerage company. I was buying during the heat and goings on in those days. And there's a few of these things. The stock had a book value of 750 yen per share. I started buying at 265, completely clean balance sheet, had never lost money. Again, this is 98, the Japanese bear market began in 1990. And so there always been odds and ends of money. And the stock had declined, and I thought, 265, I'm brilliant, I'm buying this thing. And I bought a little bit, it went down, I bought a little bit more, it went down. It got to 145. And I thought, Lord, I'm mad if somebody else is mad, so I bought some more. And then the company said they announced a buyback of 10% of the company outside. I said, that's good, put a floor under the stock. And they bought back 10% in one trade that day. And the thing went to 120. I said, this is pretty scary stuff. So that was August 1998. And about a year later, the thing had gone to 800 something yen per share. I was beside myself, exultant, sold my shares, they went to 1,700 after that. So merely that, brace yourself for terrible things to happen. I mean, but, obviously all the while making sure that this company has survivability. And the company is still around today. It's still very much around today. So, and very much a survivor. So, I mean, that was the second, so not a whole lot of tweaking has happened. Survivability has always been a part of it. But the important thing also has been to look for, so be very careful of situations where something that's cheap on an individual company level, where you're buying conservatively, and then you get steamrolled by the macro. There's no predicting that, and there will be no predicting that. But the way to defend yourself, at least partially against that, is the internal solvency and the viability of the business in the absence of capital markets, and as well as being very, very, very conservative in your valuations. That is very important. It's paramount. Being a very, very stingy person in terms of valuing securities has protected us so much against so many adverse developments. It has not eliminated the fact that things, when you start buying at 265, go to 120, but it reduces the pain relative to buying them at 700.